Looking for a high quality company to invest in? Does a 23% discount on this company sound good to you? Also want market beating dividend income and double-digit dividend growth? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major defense company providing the United States with critical defense products and services. Close your eyes for a moment. Imagine a world in which there is no human conflict. Open your eyes. Okay, back to reality, a reality in which human conflict is unfortunately universal. And in our reality, defense companies are as important and entrenched as ever. And that means growing profits and dividends for as far as the eye can see. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Huntington Ingalls Industries Inc., which appear to be trading at a significant discount today. Huntington Ingalls Industries Inc., stock ticker HII, is a major American defense company operating as the largest independent military shipbuilder. Founded in 1886, Huntington Ingalls is now a $7 billion by market cap military mammoth that employs over 14,000 people. Huntington Ingalls primarily designs, constructs, maintains, and repairs a range of nuclear and non-nuclear ships. These ships include aircraft carriers, submarines, and amphibious assault ships. The United States Navy is by far their largest customer, comprising almost 90% of the company's total annual revenue. The company operates across three segments: Newport News 60% of fiscal year 2020 revenue, Ingalls 29%, and Technical Solutions 14%. Huntington Ingalls has three advantageous and powerful characteristics working in its favor. First, there is an endless runway as it pertains to demand for their products. Sovereign defense is likely to be necessary for as long as sovereign entities exist, as human conflict is part of the human condition. That's just reality. Second, they're the only company that manufactures certain products for the U.S. military. A great example, nuclear-powered aircraft carriers. If the U.S. military orders a nuclear-powered aircraft carrier, Huntington Ingalls will be the company to get that order and build that product. Third, defense products continue to become more complex and expensive as time goes on. This consistent evolution in defense provides a built-in escalator in terms of growth, and it further entrenches the entrenched companies that have the scale and know-how to complete projects. All of this bodes very well for the company to grow its revenue, profit, and dividend for years to come. Huntington Ingalls has already increased its dividend for 10 consecutive years, and I think they're just getting warmed up with that. The 5-year dividend growth rate of 20% is a very nice start, however, and that big double-digit growth is paired with a starting yield of 2.5%. That yield is twice as high as what the broader market offers. It's also a full 100 basis points higher than the stock's own 5-year average yield. The one thing I'll note is that there has been a recent deceleration in dividend growth. Of course, investors can't expect 20% dividend growth to persist forever. On the other hand, the low payout ratio of 28.3% gives them plenty of cushion to hand out sizable dividend increases in the years ahead. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. While this yield is on the low end of that range, the dividend growth has mostly been outstanding. Looking at business growth, Huntington Ingalls grew its revenue from $6.6 billion in fiscal year 2011 to $9.4 billion in fiscal year 2020. That's a compound annual growth rate of 4%. This is very respectable. I tend to look for a mid-single-digit top-line growth rate from a large, mature business. Huntington Ingalls performed to my expectations here. Meantime, earnings per share increased from $2.91 in fiscal year 2012 to $17.14 in fiscal year 2020, which is a compound annual growth rate of 24.8%. That's extraordinary. I'd expect this kind of growth from a high-flying tech company, but it's shocking to see a rather staid shipbuilder put this up. Now, some of it stems from a poor starting point. The company reported a relatively low EPS number for fiscal year 2012. That said, a combination of significant margin expansion and steady share buybacks greatly helped to drive a lot of excess bottom line growth. The outstanding share count is down by roughly 15% over the last decade, and a net margin is about triple where it was in fiscal year 2012. I'll quickly note that I started from fiscal year 2012 and only took a 9-year look at EPS growth here, and that's because the company registered a GAAP loss for fiscal year 2011. Looking forward, CFRA forecasts that Huntington Ingalls will compound its earnings per share at an annual rate of 9% over the next 3 years. While that would be a market drop from what the company has produced over the last 9 years, it's not an unreasonable expectation. The company is starting off in a much better position as it relates to EPS and net margin, so there's less potential there to really crush those future numbers on a relative basis. They can only expand margins so much. However, I find it hard to believe that shareholders would be upset to see the company grow its earnings per share at 9% annually over the next few years. That would be a very solid result. Helping the company to meet or even exceed that kind of expectation would be their massive backlog. At $50.1 billion, the backlog is more than 6 times the company's entire market cap. An alternative way to look at this backlog would be that it represents more than 5 times the company's annual revenue, providing a revenue floor no matter what's going on with politics or the economy. A 9% bottom line growth rate would allow the company to deliver like or even better dividend growth, as the low payout ratio gives them flexibility in that regard. When you combine that kind of dividend growth with a 2.5% yield, I see a lot to like about that setup. Moving over to the balance sheet, the company has a rock solid financial position. Long-term debt to equity ratio is 0.9, while the interest coverage ratio is over 8. Profitability is robust. As I alluded to earlier, the company has expanded margins at a very impressive rate. Over the last 5 years, the firm has averaged annual net margin of 7.6% and annual return on equity of 37.1%. I think there's much to like about this company and little to dislike, and the company is protected by durable competitive advantages that include high barriers to entry, large economies of scale, technological know-how, R&D, IP, long-term contracts, switching costs, and a unique government relationship. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Whereas competition is limited or sometimes non-existent, regulation is amplified by way of direct regulatory oversight. The very business model has geopolitical risk. The current democratic regime in the U.S. government could aim to limit defense spending, which would impact defense companies. The company's backlog mitigates this risk, though. Customer concentration is a risk. Huntington Ingalls is almost completely reliant on the U.S. Navy. Speaking on this risk, CFRA states this, and I quote, "This concentration on Navy contracting subjects Huntington Ingalls to the risk of government funding cuts for major ship programs. The Navy has proven a reliable long-term growth customer, though, and we see increasing bipartisan support for Navy superiority over non-democratic nations, mitigating funding risk," unquote. The large backlog introduces execution risk. The company must complete projects in a timely and cost-effective manner in order to avoid backlash, scrutiny, and a possible reduction in order flow. I see these risks as very acceptable when looking at the big picture. That's particularly true when also considering the attractive valuation. The stock's price-earnings ratio is 11.2. That's extremely low in this market. It's less than half that of the S&P 500's price-earnings ratio. For a company expected to grow at 9%, that implies a PEG ratio of about 1.2. Even for a company that typically commands a low multiple, it's almost insulting. After all, the 5-year average PE ratio for the stock is 15. There's also a big disconnect when looking at cash flow. The current price to cash flow ratio of 6.9 is well off of its own 5-year average of 10.6, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Admittedly, this dividend growth rate is as high as I'll go, but I think Huntington Ingalls is positioned to deliver. The 5-year dividend growth rate is well above this level, and the near-term expectation for EPS growth is also higher than this. Then you have the low payout ratio, which gives them the ability to increase the dividend even faster than the level at which earnings per share rises. In my view, it seems unlikely that the company will fail to grow its dividend at this level over the long term. The dividend discount model analysis gives me a fair value of $254.88. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time valued money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Huntington Ingalls as a 3-star stock with a fair value estimate of $195. CFR rates Huntington Ingalls as a 4-star buy with a 12-month target price of $240. I came out on the high end, but Morningstar's number looks awfully low to me. Averaging the three numbers out gives us a final valuation of $229.96, which would indicate the stock is possibly 23% undervalued. Here's the bottom line, guys. Huntington Ingalls Industries Inc. is a high-quality company from every angle, and a massive backlog gives them a sales floor moving forward no matter what's going on in the world. With 10 consecutive years of dividend raises, a market-beating yield, double-digit dividend growth, a very low payout ratio, and the potential that shares are 23% undervalued, this looks like a clear and present opportunity for long-term dividend growth investors. And now for a special news announcement. JP Morgan analyst Vivek Juneja sent out a note to clients that stated the case for growing net interest income in 2022 for large U.S. commercial banks. This is due to long-term yields rising, lower mortgage prepay speeds, and expected moderate loan growth. I've made a number of videos on why the large, high-quality banks like JP Morgan Chase & Co., stock ticker JPM, have been buys, not sells, even going against my personal hero, Warren Buffett, on the matter, since he's been selling off a lot of bank holdings over the last 2 years. The banks have gone on a huge run, but like Vivek, I think there's a lot more to come in 2022. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.